Hello traders, welcome to another FreeFX video. This video is on the back of one that I made earlier today, and the previous video was really just a small beginning on the topic of the moving average indicator. Now there is a lot to cover for moving averages, and I would probably have to dedicate more videos on that topic. But what I have here is one of the things that I was considering whilst doing the moving averages video, and I really thought I should cover at some point, is the idea of ranges within currencies. So when we have a moving average, the idea is that we at some point the moving average will change direction, and we may take cues from that as to whether changing our bias on a particular currency. But the question obviously always remains, what is the range of a pair historically? And even if you trade a smaller time frame, you may want to have a look at the general picture, as a lot of trading advice consists of this multi-time frame approach, which you may have seen on other websites and videos. So in terms of technical indicators that we may use to assist us with that, and there's a lot of debate on this on forums, and the tool I'm going to use now is the Fibonacci. I'll spell Fibonacci is F-I-B-O-N-A-C-C-I. I'm sure some of you have heard of it. And I assume that you know nothing, by the way, so forgive me if I seem patronizing, and it's not my intention really, just trying to be very, very clear. This tool was created on the basis of the golden ratio and on the basis of several mathematical rules, the Fibonacci sequence, which is the 1 plus 2 plus 3 plus 4, etc. The Fibonacci sequence is part of this, but thankfully you don't have to use the calculations because the tools already have that. So the package we're going to use here, this is FXCM's market scope and trading station. So I have a chart of the cable, which is the British pound and US dollar. And I've gone back in time, as you can see, to earlier in the year towards 2014. I'm going to pick a point at random, okay? So let's say that the last candle on the right was the last day of this range, and I was going to trade from that, trying to decide where we were. I'm going to squeeze a little bit going backwards, as you can see, quite carefully. And I'm going to decide that, well, I don't want to go further than a year, so if that on the right hand side is the candle for the end of February 2015, I may want to go to the end of February 2014. There we go, that's about there, okay? So this represents a year's worth of data from there to there. So this section is my range. I'm going to just put a box around this, so just to say this is where we are, okay? And background will make it just a different color like that. Okay, so this is our range. We'll see this when we move to present price. I'll move forward eventually. Now the task here is to get you to understand different ways of using Fibonacci. So let's get stuck in, because there's a lot to cover and only more than 10 minutes are left. Now the Fibonacci tool is the one we're going to use, not the expansion, is the retracement. Okay, now let's say that this was the downtrend. Okay, let's say that the pound moved into this downtrend, and this downtrend was not a correction but an actual downtrend. Okay, what happens, as you can see from the end, is that price obviously starts bouncing off a little bit like here, but a little bit more significantly. So what the retracement idea is that the price retraces a particular trend or significant movement to certain degrees. So I'll indicate this by actually putting into the chart the retracements. So I'll do a freehand. I'll start from what I see as the top here, which is about 172. Let's use a round number, always makes it easier. And then down to 150 more or less, okay? Okay, so we'll define the parameters here, and 172 and 150. Nice round numbers. Approximate, obviously. We'll keep that as in red, make it slightly thicker, make sure that your line is then visible, and then you can select how many of these you want. The main ones are the 0.61, that's golden ratio. Half of that, more or less, is 0.38, and that's a 0.76. The 50 is just kind of halfway. The 1 is obviously complete retracement, and there we go, we don't need that, so we'll use these ones there. Okay, so we have 1, 2, 3, 4 on the top. So when we get to 1 from the bottom, that means that we've retraced the move all the way to 100%, and the price is indicated to the right of the ratio. So 0.76 will be the next level down of retracement, 166, then the 61 there, and so on. So you get how this works basically. You can have these divided all the way down to 26 and to 0. But I'm really just interested in seeing a bit further up how this works. So now let's say that I wanted to decide. I look at the cable and I've been maybe not looking at this. Somebody told you, well, somebody told me, well, look, you know, the cable has been kind of getting to the bottom. We think it's sold out. It's oversold. You should go long. This is a good time to do it. Look at this massive trend here. It's time to go long. And you might think for yourself, well, I don't know if it's time to go long. I'm going to decide for myself. So you put a Fibonacci retracement. Now, the way to do it is you draw the retracement trend line from the top or to the bottom. Okay. If this starts to pull up, you want to do that because then the retracements work their way increasingly up, 38, 50, 61, 76. The reverse, obviously, if you had an uptrend, you draw it from the top, from the bottom up, and then the retracement would be from the top of that trend back down to the bottom. Okay. Now, and there are different theories that work with this, like Elliott wave theory as well, which deals with price moving in waves, and waves actually then sort of do part retracements of each leg of the move, etc. So Fibonacci can be integrated with other theories and other indicators, but by itself is a potent tool, and potentially can save you a lot of looking around. Some people say that these levels, for example, you can see how price matches almost magically the 76 level. There's a bit of congestion there and a small bounce. Then 61, there's a sort of resistance. Other examples would be the 50 is obviously the halfway of that. Okay, there's some kind of interaction with this level, more or less. 38, and there's a sort of interaction there. So some people say, well, it's not a coincidence. It's how price behaves. It behaves in kind of levels that are determined by, you know, market cycles or whatever. So I don't know if that's true or not. Some people say it's just a coincidence. You could do statistical studies that demonstrate that basically these are just random lines, and price will at some point match some of them. So it's really up to you what you believe. But the point is that you can use to set your targets. You can use these retracements to set your targets, etc. So let's say that you wanted to go long. Okay, I'm going to increase this grid. I'm going to add the 23 as well. Why not? Okay, that's it. So that's the 23. You can see there's a bit of interaction there. And you wanted to go along here. Okay. Now you notice that there's a line there with a bit of an interaction. So you might decide that, well, I don't particularly want to go long until price goes beyond this. So what you might do, instead of putting a market order, you might put an entry order above this. Okay, so let's say you put an entry order above this at a reasonable distance. That's 155. This is 158. So maybe you put it 156. Let's put a line there where you might put a level. That's fine. 156. Okay, that seems quite. So your level is about here. That's your entry order. The entry order obviously is the one that's triggered mechanically, so you don't have to do it. You can be in bed or away on holiday, or just not looking at the charts. And so let's say you want it here, which is maybe kind of enough over this congestion and top of this wick. So your entry is here, and let's say that based on average sort of range of the price, and maybe it was like £100 at the time, I'm giving just a random example here, but just to demonstrate how this might work, let's put in an extra indicator at the bottom just to see what the average true range might be. And we're going to do that with this average true range. Fine, and there it goes. Okay, now unfortunately I revealed it's flipped forward, but never mind. Okay, so I'm going to go back to where we were, which was roughly there. Okay, so here we go. So at this point, we're looking at the average true range at the end of this candle here, which was slightly beyond that. That's better. Okay, so the price was about 118 pips. Okay, 118, 15 pips. And that's the average true range at that time. So we'd probably go 115 from there. So 156, what was it? 156.60. Try 156.50. Okay. So 156.50 plus 115, let's say 100 pips. Okay. So 156.50, 157.50. We might want to go double that, so 157.50, 158.50. Okay, we'll put a line there. Oh, try a different one. 158.50. It would be about actually just over this. Okay, so maybe just below it, just to be sure. Okay, this is where you have to be approximate. So you've got your ATR, but you want to say, so the distance between these is, just to be kind of absolutely exact, is about 150 pips. So you want to gain 150 pips, so maybe your stop would be half of that, 75, about here, 70, 75. Or you might want to do a 1-to-1, risk 1 and gain 1. So depending on how you set your parameters, maybe 150 would be here, just at the line here. So it could retrace back to the line here. So okay. So we're about on the line, or just before, or maybe just above. Okay, let's say. So these are your three levels basically: entry, take profit, and stop. Now let's move forward and see what happens. Now, okay. So let's say your entry here has not been triggered. So we're on it was the 19th of February, more or less. So we go forward. We have to wait then until May. So almost 3 months before this is triggered. And then your price just possibly touches that. Okay, so you might have been lucky to get that one filled, and if not, you would have been stopped out. Yeah, and then the next leg up, your order would have been filled. So as you can see, it's quite tricky even with the Fibonacci to always get it right, but it does give you, these two ranges you see from there. Okay, this blue line that then 0.23 then becomes a resistance, and then again, and then eventually when price breaks through, the next resistance is the 0.38 level, and then again there's interaction with that level, and then there's congestion here with this level that 0.23 is as a, well, not really a demand level but a support level. So these lines do actually have some significance, and as you can see from the 1.72 level back here in 2014, after this massive bear trend, we've not actually recovered. So the retracement of this fall has not actually been fulfilled. It's only gone up to 0.38. Now, you might argue that if you don't really do the full range, you don't get the right level. So let's go right to the bottom, which is 145 roughly. Okay. So if you got to 145 or 145, 146 actually. Now these levels look a little bit different. So you do have some interaction here and here as well, but the levels have shifted obviously. So you might want to always draw the Fibonacci lines in different ways just to check that you've covered A, the whole range, and B, that the levels that you get sort of match price in terms of future action. Fortunately, with retracement, you always look at previous price, and then sort of the price after that sort of should match that. So you've got that way of checking. There's no way of telling you what's going to happen next, but certainly if there's a big retracement you go up to the 0.50, 0.61. That gives you some ideas. I hope you enjoy this, and see you later.